Live from the Financial Thing Studios is the Peer-to-Peer Lending Essentials Podcast.
Hi, welcome to the Financial Thing Investing Essentials Podcast. And we have a special guest as always for you today. It is Stuart Law from Assetz Capital. He is the head honcho over there and got a good lineup of questions for him to address some of the new changes that Assetz has been going through, some of the new products, and his views on the peer-to-peer lending sector in general. And it's been about a year since I had Stuart on the last time, so I'm looking forward to having a great discussion with him. How are you doing today, Stuart?
Yeah, very good, thank you. Thanks, Lawrence. Good afternoon.
Good afternoon to you. So since we conducted the last podcast, you've had a couple of changes at Assetz Capital, introducing the property secured account, which is a new product. Can you explain why the account was introduced, and also a little bit about how it works and what's inside of it?
Certainly, yes. Yeah, we've had a small range of accounts which have specific investment mandates in the past, and the property secured account was an account that we sensed quite a lot of demand for. People wanted an automatic way of investing into loans that had a pretty conservative cap on the loan to value, and where all other forms of security were ignored apart from property security. And although you can do that manually, it's quite time consuming, and we felt that we wanted to give people that direct access so they can look at a mandate they like. We had a lot of feedback from people saying that's what they were looking for, and so we created an automatic mandate that if that is what they were looking for, it would invest for them automatically.
Okay, that makes a lot of sense. And also one of the other things that I've noticed too, and this is generally happening in most of the peer-to-peer companies, but the interest rates of assets have fallen a little bit since the last time that we spoke. Has this affected the lender demand that you've seen at all for assets?
No, we're at peak levels of cash inflows into the business, so we're not seeing it affecting anything. But I think your comments might relate to a longer time frame. We've had a pretty flat 8% or so return to lenders, 8 and a bit, so average lender rate, and we haven't seen a compression of that rate for quite some time. We of course do get the odd exceptional loan where there's a much lower rate that is appropriate, but I think a good indication is the data over on the AltFi data website that shows us as having a pretty consistent net of losses return, actually around the 8% mark or so per annum. And so I think perhaps what people are seeing is that we're not doing so many 12% type loans anymore, that we're finding them harder to locate when they've got very good credit characteristics.
Okay.
Occasionally we're finding some bridges of that type, of course, but the bridging market has become more competitive, and if we find a lower risk, lower LTV bridging loan, there's certainly more competition nowadays for rates that are tighter than paying a lender 12%. But we've been quite categoric in our credit appetite. What we have not done is we haven't moved our credit appetite. So pricing has tightened up, but we haven't become more lax with credit. Quite the opposite, actually. We've been expanding our credit team over the last 6 months or so substantially, and we've got about 250 man-years of experience now in that team. That's probably doubled over the last few months, and we're taking an even more pragmatic, deeply experienced, common sense approach to lending, and at the same time we've honed it right down to purely property-backed security. What that's doing is making sure that we're seeing the wood for the trees. We're not just taking something that looks sensible at first sight based on, for example, the property security, but also looking at the other risks around the transaction that tend to only be visible based upon experience, for example, or common sense. What it's overall doing is it's meaning that we we are winning a lot of business because we are recognising a good transaction through the noise that perhaps is what is stopping it being financed in the high street. And equally, we're very quick to explain to a borrower or their introducer if there is a transaction that we don't like the look of. And that pragmatic approach to lending, very common sense based, there's certainly a degree of the book Blink for those who've read it. If you have exceptional experience, very deep experience in a subject matter, your instinct tends to tell you straight away what the right answer might be. And we tend to use that on the downside. So if we spot something that experience tells us probably isn't a good idea, we would reject it relatively quickly. But if instinct is saying this is probably okay, we then invest the time to cover all bases reviewing that project. So we're not instinctually or through any kind of computer algorithm approving loans at all, but we are using instinct based on deep experience to allow a loan into our four walls and to start using up our valuable team's time to do a proper thorough job of investigating it. And I think what that's done is it's meant that we've stayed just outside the territory of banks, and we're seeing a very healthy flow of loan applications because we're taking a real world sensible view on transactions. And that view is just getting better, and it most certainly is not taking our interest rates down. So for example, if I thought our interest rates to lenders would move below the 8% plus that they're currently seeing on average, down to say 6%, I'd be saying so now, and that absolutely is not what we're doing.
Okay.
That all my data, just to cover that off, I think the latest month's data's coming out shortly, and net of losses we've produced pretty consistent, getting on for about 8% return per annum. I think the current stats on that page show 10, but it was caused by an aberration in some particularly good recoveries data and so on. But I think we're about to revert back to our normal long-term figure of around 8% or so, which is market leading. It's the highest in the table.
Okay. One thing I've noticed as a personal investor is before I used to do a lot with the manual lending account, and once I've noticed that the rates of the manual lending are somewhat lower now, just because of me personally liking to do the due diligence on some of the businesses that you offer for loans, I've started to gravitate a little bit more to the GBBA account. For anybody that's listening that doesn't know what I'm talking about, Assetz has a automated account that is called the Great British Business Account, and it's for those people that don't want to have to pick out their loans manually. You just put money in there and the loans are picked out automatically, and payments are reinvested and interest payments are reinvested. There's become less of a disparity between the manual lending interest rates and the GBBA account. Have you noticed that more money is going into the GBBA because of that, or has that changed much?
Yes. Just before Christmas, we launched the second series of the GBBA account, the Great British Business Account, and we dropped the rate from 7% to 6.25 just to make sure we were fully absorbing the flow of loans that suited that mandate apart from the rate, and to ensure also that we were properly funding the provision fund with the difference in rates. We were finding that the original GBBA1 had reached the end of its natural life as we'd finally stabilised in terms of rates in the market. We found it wasn't accepting enough loans and we had to move on and slightly lower the rate. And yes, it's been very, very popular. We've 10% of our assets under management, for want of a better word, under servicing in the loan book are now within that account, within just 3 months of setting it up. It's also proved very popular with the ISA investors because 6.25% without any tax to pay is an incredibly healthy figure. But it won't be the only way to achieve that sort of rate without the work that you're talking about manually investing in the manual lending account. We're approaching this in two different ways. We're firstly looking at whether we can extend the access accounts to have a wider range of terms. And some of the longer term accounts, should we introduce them, would have a rate not dissimilar to the GBBA2 account. And at the same time, we're approaching it from the other direction. One of the problems people have is how much time it takes to read credit reports on individual loans and to individually pick out those loans based on the type of security and the loan to value. So we will be introducing in the near future a number of more automated functions within the manual lending account, the MLA, to speed up the ability of people to invest in what they like. So if they want to immediately get some accessibility to loans that, for example, had better than 60% LTV, first charge security, that paid a rate of at least 8%, and so on, then that would be something that would be quite easy to set up and would automatically run in the background. And it will be moderately advanced. By the time we're finished with that towards the summer, people are going to be able to set diversification limits, maximum amounts per loan, and all sorts of other criteria. But compared to the current user interface in the manual lending account, where it's very much loan by loan and set your targets, we're definitely going to introduce some quicker, simpler ways of managing that. So it's much more like a spreadsheet, I think, and that should help people come at it from the manual lending account direction as well. So it's entirely possible the manual lending account becomes so flexible and quick to use and customizable to an investor's appetite that, combined with the extension on the access accounts, perhaps they join in the middle. Perhaps the other investment accounts are no longer required. If you yourself can set up something that emulates the Great British Business Account or the Property Secured Account. And that's the direction of travel. But we most definitely are wedded to the idea of continuing giving people access to manual lending and picking their own loans. Any of that automation won't get rid of that.
Okay, that's exciting news. I'm sure a lot of the manual lenders will be really happy to hear that flexibility being introduced. So now I'm going to talk to you a little bit about the collateral situation. I'm sure that you may be very limited to what you can say due to compliance issues and things like that, but it's sort of the talk right now. For, again, somebody who's listening may not know what I'm talking about. There's a peer-to-peer company named Collateral that recently closed its doors. They were not operating under FCA permissions as they were supposed to be and were forced into administration. Stuart, were you surprised by Collateral's closure when you heard about it?
I had to look up who exactly they were at first, but yeah, I mean, I wasn't following them, so wasn't particularly surprised about anything. But there's quite a range of companies in the marketplace, and I don't think peer-to-peer is much different to any business marketplace. Some businesses succeed, some don't, and there's a number of platforms that have reached scale, profitability, cash flow, or have very deep pockets, if not, and there are some that don't. And I think, as I said, I had to look up what they were, who they were when it happened. I don't think anybody's clear what happened in particular. I don't think the public-facing paperwork agrees with itself from what I've seen. So I'm just waiting for closure, and let's see what the final outcome turns out to be. But sure. I think sticking to scaled, deeply experienced platforms, ones that stick to their experience as well. I think those are the sorts of themes I've read.
Yeah.
So, and by now I think people should be fully regulated. There's plenty of time gone by. So, yeah, sticking to fully regulated platforms is a sensible thing, obviously, in a regulated marketplace.
Yeah, absolutely. One of the things that has sort of been the chatter on the internet about this closure is peer-to-peer, especially in the UK, has had a relatively good run. If you look over the last 3 years, things have been relatively smooth. And what's starting to happen is the loan books of some companies are starting to mature. The default rates have started to increase, and there's a little bit of consumer confidence that seems to have been shaken, especially by this collateral closure. You had mentioned one of the things to look at as a company's regulation status, and that you definitely wouldn't want to be investing in a company possibly that wasn't regulated. What would you tell people that were a little bit nervous about this closure, maybe to calm their nerves a little bit?
Well, I think two aspects you mentioned, isn't there? Nervousness about closure of platform. Of course, some businesses, small businesses, early businesses, underfunded businesses in any sector can fail. Absolutely happens. There's only so much space for a number of competitors in a marketplace in any case, and ones that have got to scale would tend to do better. So from that point of view, I think I've said all I could really say. Don't be surprised if little businesses or startups have issues. Absolutely, and in some cases, larger companies. Can happen. But I'm not sure, because the other point you mentioned was defaults, and I think I've got a pretty clear message, I think, from the default point of view. Defaults are the reality of lending, and particularly for alternative finance, I think it's very important to understand where alternative finance sits in any market, but in the UK and the UK market. Where does it sit versus traditional banking, for example? And in pretty much all cases, peer-to-peer is a part of alternative finance, and alternative finance is what absorbs the time, the lending demands, for borrowers who come into that market and can't get through the banking system for whatever reason. But the deeper understanding, the deeper insight into that is the following. The UK banking sector as a whole only put 600 million of new cash into businesses, for example, last year. Looking at the business sector, the SME business sector, they only put 600 million in last year. They took out about 750 million from the sector just in January. Now, okay, there was a bit of a bounce back in February, and we're not finished on the quarter yet. But in the first month, they took out as much as they put in total in the whole of 2017. The banking sector isn't supporting the UK SME. There are only a couple of years, which I think was 2015, 2016, when the amount of new money going into SMEs from banks was just about keeping up with inflation. Not quite, but sort of getting there. And all the other years before that, back into the crisis, and now after that, they're putting in something that's way below inflation and actually going negative by the look of it this year. So what does that mean? It means the banks are providing an awful lot of capital for sure versus alternative finance, but they are providing what I would call foundation capital. They're what's keeping the lights on in the country, but they're not providing enough funding for growth. That's the place for alternative finance. Alternative finance is having to take a view on businesses where there's perhaps a slightly bigger default risk. But in our case, we're a secured lender. So if we were looking for the same type of default risk and loss risk that a bank was looking for, we'd have to compete on their rates. We'd have to be putting loans out at 3% or so. So what we're doing as a business is we're looking for businesses that make sense, where there is an increased risk of default. Perhaps that's one of the reasons that hasn't ticked the box for banks. We charge more, and in doing so, we can extend a loan. But with our business being based on security, we're looking for the loss given a default to be, in an ideal case, predicted at zero at the point of lending. And we're taking good enough security, and bear in mind our loan book has an average loan to value of 59% currently. And even on a new month basis, we're typically taking new loans on the books at under 65% as a weighted average. So we're in a place that's just outside banking. That allows us to charge rates that are considerably higher, but we do it because we're taking a slightly higher default risk. And so that's the elephant in the room. We're going to get defaults. And back to your point, what should I say to those people who are perhaps reaching a point where they're now experiencing some defaults on platforms? Well, that's the point. You won't be getting significantly higher rates of return than a bank account if you're not taking some more risk. But in our business, that is a risk of default principally. We're looking to avoid the risk of a loss. when we're at the point of loan. And so, yeah, absolutely. If somebody is worried about seeing a default, but is seeking these high returns, frankly, this isn't the place. You shouldn't be here, because professional teams such as the one, we're nearly 100 people now in Assetz Capital. Professional teams like ourselves are seeking to minimize any losses that come out of a default, and we work hard at it. Sometimes we get criticized for the length of time it takes to follow through a recovery. But recovering loans isn't quick and easy. If you do a £20,000 unsecured business loan, you might send in the bailiffs, you might ask them to repay nicely, you might try and follow through on the personal guarantee. But it's a difficult and expensive job if there aren't really any assets there to recover anyway on that £20,000 loan.
Right.
And that process can go quite quickly. But if you've got a £2 million quality residential building and it's got a complicated situation around it, you really do want to be going through that process properly in order to achieve the maximum recovery. And quite often that does not involve just throwing the defaulted loan out to a receiver or an administrator and get our money back quick. You can often destroy a lot of value doing that. So we've got a lot of skill inside our business, as well as using those people when relevant and when correct. And I think our recovery stats to date show that well. In fact, we did such good recoveries a while ago that the Ep010 data, as I mentioned before, had a strange quirk to it. We over-recovered so much versus industry stats that our loss rate went positive.
Oh, wow.
We surprised on the upside, so we recovered more than Ep010 data's industry statistics suggested we should have done. But it took a little time to do it properly. So I would say that if somebody's unnerved by defaults and recoveries, the first question should be, are they happier in an automated account that deals with that and doesn't bother them with day-to-day noise? But if they're fundamentally bothered with it, perhaps peer-to-peer isn't for them, and perhaps go back to a more simple savings account.
That makes a lot of sense.
A lot of words, but frankly, that's where we are.
Yeah.
And if you look at the charts of all of the main players and their returns long term, it's interesting that there isn't a peer-to-peer lender yet that has shown a negative return for any year. Admittedly, only Zopa has been through a cycle to date, but a lot of people have stress tested their books, including us, and that's how we think. We're thinking, how do we avoid going negative in a cycle in any year where the losses would exceed the coupon earned? And I think that's one of the overriding objectives of the industry.
Right.
To see if they can manage their credit book to a position where that happens. And I think we all know, don't we, what happened in the last cycle and what we'd expect to happen in any cycle. If you're in the stock market or somewhere else, you'd look to see a pretty poor capital loss, I think, on investments in other asset classes as well. So I think it's quite interesting to watch how the sector evolves over time. And there's no promises or guarantees at all, but it's an intention, I think, of the industry to maintain that positive return throughout cycles. And so far, Zopa's the only one that's got that track record.
What has Assetz learned about effective default recovery along the way? We've learned investors like it to be done quickly. We've learned to communicate why sometimes that's a bad idea. We could have put, we had a default, it was a particular a small student block, for example. That's an example. And perhaps if we had put that straight out for recovery day one, we had offers in that would have recovered, say, 50p in the pound, because there were problems with the student block at the time. But what we did instead was we took a very proactive approach, and we built a plan with the administrators to rebuild the value and to put right what the borrower hadn't done, which created the problem. And so we took our time to do that, and it's quite unusual because it's a property that's in administration at the moment, but producing strong regular cash flow for lenders because it's fully let now.
and it was only partly let when we took it over. So we've rebuilt value in that property. We've carried on paying a very healthy coupon, and we've rebuilt the capital value as well. So sometimes you just have to do the right thing. And it's quite a popular phrase at the moment, patient capital. If you go back to the last crisis, the global financial crisis, a lot of the money was created, a lot of the losses, was created by people having to act generally in a panicked way and sell off things very quickly at a distressed price. I think lenders have always got the choice what to do, but panic is a human trait. Humans tend to sell at the bottom, buy at the top. And if things look bad, people tend to sell down at the bottom. And the bottom is the giveaway, isn't it?
Yeah.
You can expect to do better. And the residential property marketplace dropped dramatically in the last cycle here in the UK because the only people selling were those who had to sell, those who panicked in some cases. But very quickly it recovered. Afterwards, once those forced sellers disappeared out of the market, true value came back again. And I think that's the words. I think people coming into the peer-to-peer marketplace, particularly for secured loans, would be well advised to have a patient outlook and not to adopt the normal human trait of panic and sell. I think it was Rothschild, wasn't it, that said, buy when there's blood on the streets.
Yeah.
But human nature, unfortunately, is to sell when that happens. And at the very least, hold through the wobbles, because wobbles tend to dissipate.
Let's talk a little bit about Assetz stability as a company. Very important that a company gets to profitability. I know Assetz has been a profitable company for a while. How is Assetz now with regards to its profitability, and what are you doing to increase that as a company?
Yeah, we haven't announced final figures for the financial year just finished end of March, but you're going to see revenues well north of 10 million. You're going to see profitability that's approximately doubled from last year's 1 million profit or so. And we're going to see healthy cash in the bank. We're in a good place. The lending in the last quarter was an all-time high. We will come out at about getting on for 62 million, possibly higher, of lending in that quarter. And we have possibly another record level of lending happening this month in April. So profitability is healthy. The business is healthy. There's a lot going on, and we're growing at a fair rate, but we're trying to manage that rate. The ISA, for example, brought in a lot of cash. So ISA investments now represent getting on for 10% of all of the cash on the platform within just 3 months.
Wow.
So that bodes well. I wouldn't be surprised if it was 30, 40, 50% in a year's time. And that's helpful for people, because we're not, unlike a lot of industries within the ISA world, different asset classes, we're not planning to have a difference of rate or a difference of charging. So we pay all the ISA costs for people. So they're getting the same investments, the same types of investments, the same accounts, but with no extra cost and with no tax to pay. And we are seeing a significant number of transfers, but we haven't published formal data on this so far. But one example would be that almost all, the vast majority of cash coming in onto the ISA accounts is new money on the platform. So the vast majority.
Wow.
So not people just moving money from the standard accounts. It's ballpark around 75% of all cash seems to have come in so far from new money arriving on the platform. And the ISA is about 10% of our entire cash on the platform.
That sounds like lender response to the ISA offering has been very good. Has that changed? If you have this big influx of new cash through the ISA, have the demand and supply levels stayed relatively balanced regarding bringing in enough loans to have enough money to match to that?
Yeah, we don't have too much lender capital. We've grown, as I said, the team is now approaching 100 people. When we filled the current vacancies, and our field team, our relationship directors in offices from north of Edinburgh down to the south coast now, near Southampton, and across with a couple of people over in Belfast as well. We're covering the whole country, we're covering more and more parts of the whole country, and that relationship director team is really kicking in with its origination.
Mm-hmm.
So, no, the balance is there, and we're certainly open to a lot more cash.
Okay.
There's a lot of demand for our product, and we don't see any need or wish to adjust rates. We don't adjust rates based on weight of capital at all.
Okay.
Instead, it just allows us to widen our marketing to borrowers.
Okay. That's good to hear. I'm gonna let you do a little bit of a how about a little 1-minute sales pitch as to why somebody would consider putting their ISA money into Assetz versus the other, peer-to-peer or crowd lending options that are out there at the moment.
Yeah, thank you. Well, first thing I'd say actually is it's pretty healthy as an idea to diversify across platforms. When you first read up on the ISA side, you might assume you can't do that because you can only open one innovative finance ISA in a year. Mm-hmm. What people might miss the point on, though, is that you can do transfers of prior year ISA allowances. And I fully expect that the ISA industry for peer-to-peer is going to work differently to the cash ISA industry and the equity ISA industry. So I would forecast that actually we're going to see strong demand throughout the year, for transfers from underperforming cash accounts where people give up on cash bank accounts and decide to start investing instead, but don't want the volatility of the stock market. I mean, here we are talking today, and the American market looks like it's on the brink of another big step down again. It's disconcerting to people. So I think transfers in ISAs is going to be the big message, I think, over the rest of 2018. And so people can diversify cross-platform. But why should they pick us for their new money this year? Well, we offer to those people who want to invest in manual lending one of the few choices to do that with a secured, scaled business with a proven track record that's third-party verified by Ep010 data. There's only a handful of lenders who've dared, that probably is the right word to use, dared to open their lending book for third-party detailed review, in this case by Ep010 data. There's only a handful of people, Funding Circle, Rate Setters, OPA, ourselves, Market Invoice in the UK, who've done that. Others either can't because they haven't got the data or won't open that book for analysis. And our analysis shows that we have the highest net return, net of losses, but also the lowest risk ratio, which is your gross returns versus risk versus losses. And so, Ep010 data charts show us to be perhaps the best risk return ratio. That's the way they phrase it. And we're getting on for about 8% per annum net of losses if you go into the manual lending marketplace. And even if you don't, we operate our Access accounts, which are a really simple, massively diversified way of investing. So I think we offer a great choice of accounts. We offer market-leading rates. We're very established. We're profitable. We've got plenty of cash. We've scaled. We're getting on for 100 people, and come back in a couple of years, we might have 200 or 300. So, we're a proper business. We mean business, and that's what we're here to do. Act as a good custodian for people's money, and let us do a good job of lending it, and let us do a good job of recovering it when occasionally it goes wrong. That's why people should come to us. We're deeply experienced. We know what we're doing. Things happen, and we like to think that we deal with them well and fairly.
Stuart, so let's talk a little bit about the green energy account that used to be very, very popular with lenders. Now it's been put on pause. Can you give the listeners a quick explanation as to what is going on with that account and why that happened?
Yeah, I think like any government tax breaks, they tend to be used to incentivize a type of activity, a response from the market. So in this case, we had the feed-in tariffs, the FIT tariffs, which were exceptionally generous when they started and gradually got scaled back. And I think what's happened here is the government has been reducing the subsidies, and it's significantly reduced the entrepreneurial activity in the renewable sector, and in particular the wind turbine sector, which we were focused on. Because the government's formed a view that their job here is done. You can see the point, actually. If you look at news reports, you can see that we're getting new highs of amounts of energy produced by wind turbines, for example, this year, just gone. And we're seeing extremely high percentages of energy being created. Northern Ireland is way ahead of target for its renewable energy electricity creation. Mm-hmm. So I think governments have generally formed a view that their job here is pretty much done. They've scaled back their subsidies. That's caused the entrepreneurial new money to pull out, perhaps, but larger investors, the big energy companies and so on, are still going at it full blast. So I think they've incentivized the market. It's got to scale, and we specialized in funding principally construction projects for entrepreneurial investors in the more heavily subsidized turbines. Mm-hmm. I think that market has now gone, and we've just seen the loan flow dry up, as a lot of other people have. Some people have chosen to go off into other areas, so areas that we're less comfortable with. So offshore wind turbines in some cases, other more untested areas of renewables, and our investors aren't keen on dabbling in those newer areas, and neither are we. So we've paused that account for the time being. We've got a few loans coming through that are still there, still on the tariffs, but I would expect it's quite possible we need to wind up that account in the near future and move on, because we're not seeing the loan flow that we'd need for our investors to be highly active in that market.
Stuart, let me ask you a little bit about valuations on. You had mentioned that a lot of the loans that Assetz is doing are property backed. One of the sticking points at the moment that I'm noticing for lenders is some of these valuations they're finding to be somewhat misleading, not always particularly accurate. What is Assetz doing to ensure that valuations received by the surveyors are actually accurate? You know, especially when it comes to default recovery. It's a bit of a problem if somebody says a property's worth $1 million on a valuation. It turns out that they're struggling to get $500,000 for it on a liquidation situation. So what is Assetz doing to make sure that these valuations are realistic, that they're being provided?
Yeah, there's lots of specialist nuances to valuations, and I could talk about different loan types and the types of risks within those loan types, within the valuations for those loans and for the security on those loans. And I could sit here all afternoon and do that. So I won't do that as widely. What I'll do is I'll just cherry pick out a few examples of where you get problems. So I've already talked about one where, for example, a student property, if it's fully let and is achieving the proper rents, we'll have a valuation which is based on a more commercial basis. What it will be doing is it won't perhaps in that case be valuing the bare bricks and mortar, because that would come in at a much lower figure and would mean that the rental income against that was unreasonably high and wasn't a realistic figure. So instead, you'd value that type of property, and perhaps quite a bit of commercial property, on a valuation basis that takes into account much more the rental income flow. So your risk is that the rental income isn't what you thought it would be. So if somebody mismanages a building, you could see it worth less if you had to step in one day at the wrong moment than you thought it would be if it was fully tenanted. So you can have a borrower mismanage a property. That can devalue the property. You can also have situations where properties are being refurbished. If you do a very bad refurbishment job and you do some demolition works that go too far, what you're doing is you're destroying value before you rebuild the value with the refurbishment. And that's a latent risk within refurbishment type projects. So that's another example of a problem. You can also have problems where you have to really take great care over the type of valuer that you use, how large they are, their area of expertise, the level of PI cover they have, and whether or not they're anywhere near the property in question. Mm-hmm. So those sorts of things can raise flags. And yeah, you can get situations where somebody 100 miles away might value a one-off property. You might have a situation where that one-off property is so one-off that it's not really got enough comparables to form a view as to whether it's the right figure. So perhaps it's an area where houses are typically $500,000. You've got a house here that's very special, one-off, will attract a limited number of buyers due to its design, and it's £2 million in theory. Now, that's asking for trouble on several levels. You've got a one-off property that's right at the top of the market for its location. It's got design characteristics perhaps that limit the marketplace because it's a bit quirky. Or perhaps a very large property with only 3 bedrooms because that's what the guy who built it wanted. But it limits its market for that scale of house. And so on. So you have to be very careful how you instruct the valuer, the purpose of the valuation, what are you actually trying to achieve? And I think perhaps, without going into too much detail, but I think you can see what I'm saying, is a platform trying to protect itself and its lenders, or is it trying to justify a valuation which would allow it to extend the loan the borrower needs? Mm-hmm. So it's not good. And sometimes, of course, you can be let down by valuers. That absolutely does happen sometimes. But in many cases, you can see that coming. In most cases, you should be able to see that coming. And what we do is we will sometimes second guess valuers on the downside, not on the upside. So if we get a valuation report at $1 million and we look at that particular property and we form a view, we cannot get comfortable with that figure based on, for example, comparables that we can find or the quality of the comparables that are listed in the valuation report, we might decline to accept that valuation as good support for the loan. But we would never go the other way and say, actually, we think it's worth more than the valuer is saying. And first pass, if we don't think we're comfortable with what the valuer is telling us and we're thinking on the downside, we'll then go back to that valuer and ask them to clarify, provide further evidence, and to get into more detail. And if we still can't get comfortable, we wouldn't go ahead. Mm-hmm. Occasionally, I've heard of some platforms accepting third-party valuations. If your valuation isn't addressed to the right party, like any contract, you can't rely on it.
Right.
Another really big issue. I could go on about lots of issues to do with valuations. You just need to keep your wits about you, construct the valuation on the right basis, ask for the right type of valuation because it matters. There are lots of methods of valuation. And then you need to take a view on that and you need to pick the right valuer. The method of valuation, most of our valuations are done on a modest time frame, typically about 6 months for selling on the security. If you go in for 30-day, 90-day type valuations, that's a fire sale. It's going to produce a very, very aggressive discount in many cases to a property value. Right. We tend to ask typically for a VP 180, a vacant possession 180-day basis, but sometimes we do look at businesses on a trading basis. But that's difficult because you're beginning to build the value of the trading business on top of the bricks and mortar. And therein lies quite a bit of risk if the trading business doesn't exist. It's a bit like taking security over a Woolworths tenanted shop. It all sounds great until the day Woolworths goes bust. Yeah. And then all you've got is your vacant possession value for your bricks and mortar. The valuation before that would have usually, from what I can see from what's happened in the end with Woolworths, the valuation beforehand was much higher because people value the rental income stream from that big tenant.
Mm-hmm.
But it turned out that couldn't be relied upon. And that wasn't apparent perhaps when you did your loan 5 years ago. So that type, commercial valuations, be very careful about. Be very careful where it's valuing the lease rental income well above the 180-day type vacant possession valuation. Valuations as a whole should be an indication of the security. The secondary layer is who is the team who is instructing the valuation and deciding what level of that it can rely upon, and then would deal with any recoveries afterwards. So it's a combination of the valuation quality and the team who's going to manage that valuation and the outcome of any recovery.
Mm-hmm.
Combination of the two that's important. And just throwing a property that defaults into some kind of process is one of the quickest ways of losing value. And I have seen quite a number of occasions in the marketplace where people are doing that with their first defaults in order to appease investors. But I don't think it's going to work out very well on a recovery percentage. So it's a short-term appeasement in my view. You just have to stick to your guns, do the right thing, do it properly and get the best recovery. And I think that produces the best investor outcome.
A lot of lenders, especially ones that are sort of new into the peer-to-peer business, I don't think they realize just how long the recovery process can take, especially when there's property involved and it gets very complex.
Yeah. It is. I mean, people think, well, it's just a property, sell it. But I think a relatively fast recovery for us would typically be about 6 months.
Mm-hmm.
We've had a couple that take a couple of years or so if you get very difficult situations or very difficult borrowers. But the thing is, just keep going, keep plugging away, and people should just be relatively well diversified in order to make sure that they're not too exposed to those loans in the short term whilst they're being recovered.
Okay.
But it's part and parcel of the business. It's what peer-to-peer lending is all about. If you avoid putting all your money in one loan, the comparable of that is put all your money into one share on the stock market.
Mm-hmm.
If you do that, it can happen. Sometimes you wake up in the morning and the company's gone bust overnight.
Mm-hmm.
It does happen. If you do a show of hands with 100 people in the room, it's quite surprising how many times you find people who've encountered that. Maybe not surprising. And the same would happen in peer-to-peer lending occasionally if you don't diversify widely. But if you do, you'll find it quite hard to find somebody who was following a sensible investment strategy and has actually lost money.
Stuart, give me a quick view on your opinion of the general health of the peer-to-peer industry now.
Yeah, it looks pretty strong to me. The industry has gone through the process of pre-regulation. It's gone through the process of being interim permissioned. It's pretty much all platforms now have gone through that process and come out the other side, a handful of exceptions accepted. And now that they're fully regulated, they're just continuing to build their businesses. I think there's the concern that you can see in the banking sector from the potential risks of Brexit impacting on bank lending. But the alternative finance industry seems to be taking up the slack. And from a secure perspective, that doesn't seem to be much of an issue. We have seen warnings from the Bank of England about consumer lending, and from pretty much every party that can open its mouth, really warning about the more aggressive end of consumer lending. Frankly, lending to consumers at 3% doesn't seem well risk adjusted to me, and I think that's got to come back. And equally, lending into subprime, perhaps this isn't the right time to be doing it either. So I think both consumer and business lending both have some challenges ahead, but with good scale and the businesses with big, experienced teams, I'm very confident about the ability to weather any storms and handle what comes up. After all, what have we really done? We as a business, we don't do automated lending, so the peer-to-peer moniker for us refers to our raising of investor funds. The lender side, the lending outside to borrowers, is just basically a very high spec team of banking and credit professionals. We're just doing what any best practice business in that marketplace would do, but without any baggage to distract us and confuse us from years or decades gone by. We're focused on our own clean loan book, and that's what we're doing. So the peer-to-peer side applies to the investor side, and I think that what we've seen is that's matured, that's strong, but our lending side, lending out money with the team we have in place today, is a safe pair of hands, and it's doing a great job. The other platforms are doing similar, and so I think, the largest guys who've hit critical mass are in a very good place, and hence the marketplace is.
Stuart, there's some listeners and readers of the website who don't have a single pound invested into peer-to-peer, who are sort of looking to dip their toes into the waters. Give me 2 or 3 quick tips to somebody that's never lent any money to peer-to-peer before.
I think in order to avoid any surprises, because surprises could then put you off something if they happen in the early days before you've had a proper experience, stick to the larger platforms, make sure they're third-party verified, and that's not just the AltFi data team that verify our data, but there are 1 or 2 other sites that third-party verify. Look for consistency, look for full FCA regulation, and without naming names, make sure that they're on the FCA register at the same time, not just on the website. That was one of the problems people had recently. But that's the same with any industry. So FCA fully regulated, long track record, third-party verified data, plenty of good reports such as on Trustpilot, somebody you can speak to on the phone that talks sense, not just a website, somebody with scale, somebody with profits, somebody well funded, somebody with lots of news around them that talks about that business doing well, and just dip your toe in. Just put a small amount in. The Assetz Capital minimum is £1. We'd lose money if you put £1 in, but we don't stop you because we don't expect you to stop there. People aren't going to mess about setting an account up to only invest £1 with our sort of 8% net return currently produced over the last few years. So experiment. Try 2 or 3 of those platforms that fit those bigger criteria, give it a go and see how you encounter it, see how it works. And I think our position is that this is a third way of doing things. We've got the cash type investments, safe but little return, unlikely to change even with the bank base rate changes coming up over the next year or so, and not as roller coaster as the stock market. Different. We've had a great run on the stock market, and I think last time I was on, I commented on it, and people did do 1 or 2 comments back, disagreeing with that one part of my talk. But I think we've probably reached that peak now, and we're beginning to decline. So I don't think returns over the next few years will be that bright in the stock market. Perhaps they will, perhaps they won't. But returns on peer-to-peer, the big players are all intending the same thing. Positive returns long term. So I would suggest stick to the marketplace, diversify on 2 or 3 platforms, but also make sure you diversify well when you're investing. And frankly, if you put £1 in or £10 or £100, you're probably better putting it into some kind of automated, highly diversified account, because that will give you a better experience for a lot of money. If you're putting 100,000 on, as some people do, then fair enough, pick your own loans. But if you're going to put a small test amount on, test the automated accounts first.
Good advice, Stuart. And just to let you know, I'm still trying to build that crystal ball which will tell us the future of the stock market. And it's a slow process. But a couple of other questions for you. Last time we spoke, we talked about a couple of the challenges that Assetz was facing. I think that one of them was the delicate balance between having enough money from the lenders and having enough borrowers. Today, what are some of the, if any, of the challenges that you're still facing as a business now? I know you talked about scaling. What are some of the challenges still that Assetz faces today?
Well, as of today, we've moved premises. We've got plenty of space for growth. We're attracting some of the best people in the industry at all levels, whether it's risk, credit, borrower face-to-face work, you name it. We're attracting really good people. So I'd still say that the biggest challenge is probably hiring at the right rate. We're certainly trying to hire at a faster rate than we are, because hiring good people is what drives our growth. We don't grow by changing our credit model. We grow by hiring more good people who can help face-to-face, spread the word on alternative finance. So, yeah, that's one challenge. Balancing lenders and borrowers in peer-to-peer is always going to be part of a challenge, because banks can literally print a loan out of thin air. That's what the banking license lets them do. We're not allowed to do that, so we always have to maintain that balance between lenders and borrowers. Too much cash and we get cash drag and people aren't returning money. Too little cash and we're not funding as many loans as we could have funded. So always going to be a challenge, I think, for a true peer-to-peer, unless you get some kind of very flexible, deep-pocketed rich uncle who will fund you. And I think given those rich uncles come and go through cycles, even that isn't an answer. I think the balance of lenders and borrowers is one of the biggest challenges for any peer-to-peer lender. I mean, look at the impact on Zopa with its over-origination. Over-origination of the lender side had to close its doors for about a year to new investors, because the existing investors had so much faith in the business. They were funding everything that moved and they couldn't accept any new lenders. Otherwise, that had prejudiced the ability of existing to invest. I think we'd like to stay away from that place, but equally we don't want too much cash on the platform. But I'd say that's one of the bigger challenges. The wider challenges, the really big ones for the industry, are making alternative finance more visible to businesses. Big challenge. The government's failed a couple of times trying to do that. We're working on whether we can solve that problem and bring alternative finance as a whole more visibility to businesses for the benefit of the whole alternative finance industry, not just ourselves. That's one big challenge. And another big one is making ISAs measurable in the scheme of things. We've not had the stats quite yet for the ISA season for this last year, but whether it's 50 billion or 80 billion this year, frankly, peer-to-peer will be a very small fraction of that still. And I think that's one of the big challenges for the industry. How do we get the innovative finance ISA really up there in being recognised as an alternative to those other ISA types? So yeah, I'd say most of our challenges are more industry type challenges, shared. We've gone through that critical mass, and so I think it's more industry challenges now that we face.
Right. Okay. And last question for you, Stuart. Is there anything you'd like to share about Assetz's plans moving forward, any future innovations? I know you'd mentioned possible changes to the manual lending account, which sound very exciting. Is there anything else you want to tell people about which your plans are that you might be excited about?
Yeah, I think we've tried to be quite open through this, and I think those improvements to the manual lending account, as I said, to make that much slicker and easier to invest through that account is important, because if it takes time to invest manually, we're creating a need to earn more money and a loss, if you like, for people's time spent doing that. So if we can simplify that, it'll improve investors' return by reducing how much time they need to put in. We're going to improve, if we can, the access accounts as well. We are looking at some other innovations, but it's too early to announce them, I'm afraid. But I think you could describe it as plugging Assetz Capital into the wider financial services infrastructure. So at the moment, we're a peer-to-peer lender. But in the bigger scope of things, I think what you'll see over the next year is more connections into that the rest of the industry, the rest of the financial industry. Whether that's connections into banks, as has already been talked about, connections into marketplaces that we've already announced. For example, we're on the Bud marketplace. Those sorts of things, but also other innovations. We're seeing a lot of innovation from some players. Revolut, I think, is probably at the most extreme end of innovation, at one end of the spectrum, and one or two high street banks are at the other end, currently still doing pretty much nothing in innovation. And on that spectrum, I think you can expect to see us at least right of centre. So fairly innovative, but not to the point where the wheels are falling off or we're pushing new ground to a dangerous level. I think what you'll see is us making innovations that are sensible, well considered, and quite exciting when they come, but not to the point where people are asking whether we've gone mad or we're ahead of our permissions. There's no intention to do that.
Okay, great. So continue to watch this space. And if you haven't checked out Assetz Capital, I have a review on the website, financialthing.com. It is a company that I personally invest my own money through and have been doing for a number of years. Take a look at their products. I think they're one of the stronger players in the peer-to-peer lending industry. And a lot of exciting future innovations, it sounds like, that are coming, and we'll continue to watch their growth. Stuart, I wanted to thank you very much for your time taking to do this and for letting everybody know what you're up to. It's very helpful for them to see the face behind the company. Provides a little bit of trust and a lot of insight that a lot of the times we don't get from peer-to-peer companies. So thank you very much for doing that.
Sorry, I'm the only face. Honest, there are getting on for 100 other people in this building or scattered around the country. But we're like a stick of rock. If you cut through us, we're all the same. We all think the same way.
Well, thank you again, and we'll continue to watch what's going on at Assetz Capital.